Hello and welcome. You're watching Business Plus. I'm Shweta Kothari. We're bringing you stories from the world of business policy and economy. Suyash Maheshwari here with me in the studio. Suyash, good afternoon.
Good afternoon, Shweta.
Let's take a quick check of the markets. Markets ending in red this afternoon.
Yes, Shweta, you're absolutely right. Markets came under a fair bit of pressure throughout the session. Actually, we saw, in Nifty and Sensex both extending their losses. Now, Indian markets have, after today's correction, extended its losing run to about 2 sessions now, with the last tick for Nifty coming in at 18,989 mark. So we have broken below that 19,000 mark, which was seen as a crucial support zone for the markets, going forward. Now, Nifty opened about 35 points shy of that 19,100 sort of a zone. And, in the morning trade, we saw Nifty move briefly in the green, but it touched an intraday high of 19,096. So clearly at 19,100, there seems to be a good bit of resistance playing out. So going forward, I think 19,100 will be a crucial level to track as far as resistance is concerned. After that initial bounce, as I mentioned, both Nifty and Sensex continued to decline for the remainder of the session, and the close also came just about 15 to 16 points shy of that day's low. So the markets ended near the day's low pretty much. As you can see on your screen, Nifty at end was down about 0.47%, closing in at 18,989 mark. Sensex, on the other hand, lost about 280 points or so and closed below that 63,600 sort of levels. Now, mid cap and the small caps, the broader markets in general were trading in the green this morning. However, we saw some correction setting in the last hour of trade in both mid caps and small caps. Nifty mid cap 100 was down 0.26% at 38,775, and the Nifty small cap 100 was down almost, it was flattish, down about 0.07% at 12,640 sort of levels. Volatility also spiked by about 2%, and India VIX closed above the 12 mark. Now, one point I want to highlight, about the headliner, especially Nifty. In the bounce back that we saw play out in the Friday and the Monday session, Nifty surged about 400 odd points or so. But the correction that we have seen in the last couple of days, it has pretty much wiped out 250 points of that 400 point bounce. So it looks like that the bounce that we saw on Monday and Friday was a dead cat sort of a bounce, which indicates that the primary trend going forward will remain bearish.
All right, primary trend expected to remain bearish. That is what our analysis, our expectations are. Rohit Srivastava, founder, Strike Money Analytics and Indiacharts, joining us on the show. Rohit, good afternoon. Thank you for taking time out. What are your expectations for a near-term support level for Nifty?
So we have made some kind of a very short-term low at the recent bottom. So we are closely watching whether 19,838 can hold for a period of time, and by a period of time I mean maybe a couple of days, a week at the most, because we are heading into this event for the US, the Federal Reserve FOMC meeting tonight, after what has been a continued 3-month decline for the US indices. So they are getting slightly oversold. You have a setup where you can get some kind of a pullback retracement in the very, very short term. And if the event only ends up being exactly what everybody's expecting, so then it becomes very discounted. That means that the FOMC doesn't really raise rates, leaves one possible hike on the table for the future, which is exactly what they did the last time, and that's sort of what the market is expecting. So if it plays out as expected, the short-term impact ends up being one of cover of news, essentially, for those who've been shorting these markets or been selling these markets, and you do get a near-term pullback. So we do start with the possibility that if the Nifty itself here ends up holding the current levels, which is sort of today's lows around a 61% retracement of the last 2-3 days bounce, we can attempt to move higher even towards 19,450 in the very, very short term, which is in a 1 week kind of time horizon. However, I do believe at this moment that any such bounce would only be retracement of the ongoing decline. Sorry.
Okay.
And possibly we will see more selling in the future.
All right, since we are on FOMC, the expectations could be met or could not be met? What are the expectations? So let's quickly begin with two case scenarios. A, there is a rate hike. In case of a rate hike, how are you expecting markets to move? And B, there is no rate hike, that further pushes the idea for a rate hike to the next FOMC. In both case scenarios, how are you expecting markets to react?
So the only scenario in which markets could be relatively more bullish is one where he actually changes course, of suddenly turns dovish, that no, we can't really keep rates this high because we need to support the US bond market. There's a lot of treasury issuance really coming up in the months ahead. If that is the stance, then it would be a very changed scenario, because the markets would start reflating based on the potential that they're going to buy bonds, or even resume QE or something like that. Now those things, that is the least expected course of action. The expected course of action is somewhere in the lines of what you've just asked. One is doing nothing, but still leaving the potential for a rate hike in future, which, while short term, like I said, it can be a discounted event, but in the medium term, it still keeps the market very tight on the liquidity front. And that is something the markets are not going to like eventually, because if you even keep rates at the current level, say for another 2 quarters, you are going to end up in a slowing US economy. It's already starting to happen. There are different parts of the world that have already slowed down, from Europe to China, and that's not really helping. So scenario number one just slows down the slide, but eventually we are going to head lower because of the potential of a economic slowdown. The other scenario is you actually end up hiking rates. That is again a least expected path, because inflation data has been cooling, even though it has stalled right now. It's not exactly started to shoot up, so they don't have enough reasons to tighten too much, which is why again that's not the expected path. But if they do raise rates, that would really hurt markets and lead to an more immediate sell off across the board. So that's, I think those are the scenarios that I can build upon.
Now, Mr. Srivastava, Suyash here. Good afternoon, sir. I mean, I was just listening to what you were saying. Seems like, Fed is in a catch-22 sort of a situation. Can't cut rates because, inflation is running too hot. Can't raise them because bond yields are already at a 16-year high. I mean, what's the escape? What's the simplest path, or the path of least resistance for Fed going forward?
So the path of least resistance is essentially the one that the market is anticipating, that they do nothing right now. They let the market figure it out. And the market is going to figure that out in its own very tough way, which means that you may not necessarily see immediate action. Okay, so you can say, okay, fine, we leave rates where they are. But like I mentioned, if rates remain where they are for even another quarter, you will end up in an economic slowdown. And can that economic slowdown, so slowdown is a mild word, can it really become a recession? And that takes us to the other major indicator, which is the yield curve, right? The yield curve has been inverted now for more than a year. And history shows that it can be 6 to 12 months ahead of a potential recession. But recessionary conditions only start showing up after the inverted yield curve actually starts steepening. And that is something that we have been witnessing for the last month and a half, that the yield curve, which had almost inverted between the 2s and 10s, inverted to around 110, 115 basis points, is now down to only 20 basis points to 15 basis points. So that's a huge reduction in the inversion, which has happened. And that's the first early sign that we are now closer and closer to the point where the economic slowdown can result in an economic recession. And that is why stock markets have started to react to that potential in the coming future. So that's, I think, the more important indicator than really what the Fed does, because if the Fed simply leaves rates here, they try to just play it safe. Okay, fine, we won't do anything. Okay. But these high rates will slow the economy down anyway.
So US Fed caught between a rock and a hard place. No easy way out, no easy situation out there for US Feds at this point in time. But shifting focus to and coming back to India, let's take a look at some of the sectors that you're tracking.
Yes, Shweta. So first, let's talk about Nifty Bank. Today was the options expiry for Nifty Bank. Nifty Bank corrected by about 0.34% in today's trade, and sits at around 42,700 levels. Now I was talking to a technical expert joining us who joined us this morning, Akshay Bhagwat, he was of the opinion that the index has formed a double top sort of a pattern, which and it has pretty much identified that pattern, and if it corrects from here on, it could we could see a correction of about 1000 to 1500 points on Nifty Bank. As you can see on your screen, Nifty Bank also is below that 43,000 levels, so maybe we should brace for that sort of a correction. At least that's what the word coming in from analysts is. Nifty IT was also under a fair bit of pressure, corrected by about 0.8%. Now this is of course because Federal Reserve policy very much affects the IT pack on the whole. Another sector which was trading in deep in the red was a Nifty metal pack, down about 1.43% or so in today's session. The media pack on the contrary was the among the gainers. It rose about 0.88% in today's trade. Pharma pack also saw a bounce back. It was up about 0.35%, and the PSU banking space was up about 0.32%.
All right, that is as far as sectoral performance is concerned. Nifty metal there down by about 1.43%. What's happening here, Suyash?
I mean, I think it's a fact that the PMI data coming from China yesterday showed that there was a contraction in manufacturing activity. So the demand going forward is expected to remain muted. I think that is what's playing out in the metal pack, because I mean, if you
let's ask Rohit if that is what is playing out with the metals pack. Rohit?
Well, that is one of the angles. The slowing Chinese economy has definitely played a role in slowing down demand for commodities. But simultaneously, like I said earlier, there is also a slowdown in Europe. There is a general slowdown everywhere, and it is driving up also the dollar. When it comes to commodity prices, the dollar itself, is sort of inversely correlated with the entire commodity complex. So when you get a strong dollar, you usually find that commodity prices are falling, and that's sort of been the pattern over the last 4 to 5 months. So what that's really meaning is that it continues to put pressure on commodity prices. Apart from the demand environment, which is weakening, you don't have a dollar environment which is really weak either. So both of those combined are putting downward pressure on commodity prices, which are not able to pick up, and subsequently leading to selling in the cyclical commodities space.
Okay. And Nifty Realty up about 1.55%, outperforming all the other sectors. What's happening up? Is the pack overheated here? I mean, we've seen wonderful returns weeks on weeks.
Yeah, so I think it's the general concern about markets that is impacting many of the other sectors, because typically we've seen a lot of rotation over the last not just this year, but I think most of the post 2020 rally has been one of rotation, where every sector has participated from time to time. But what is happening now, as people start fearing this entire story that we've been discussing, from the US slowdown to its impact on Indian markets, is that if you do get a major cut in global equities, and if it does impact India, then it sort of impacts everything. And so every sector starts to underperform in that sense. And that is why you're probably seeing these cuts almost across the board. If you look at 1 month returns, every index is negative. I think there's probably only one index that might end up showing some kind of a positive number. But every other index, I think, is right now showing a negative number on a 1 month basis. Yeah, and reality is that one index that is
absolutely
is a 1
no, exactly. Realty is standing out there.
High,
multi-year, multi-decade high, exceptional performance from Nifty Realty. But we're going to move on now to an important story that we're tracking coming by the way of earnings season. Sun Pharma came out with its Q2 numbers, surprising streets, Suyash.
Yes, Shweta, the numbers largely are ahead from what the street was expecting. I mean, on the profitability front and the revenue front, Sun Pharma has exceeded what the market's expectation was overall. However, margins were slightly softer than expectations. Now, as you can see on your screen, net profit for the quarter was up 5%. This is on a year-on-year basis, coming in at 2,375 crore or so. This was also ahead of what the street was penciling in. Street was actually expecting profit to decline on a year-on-year basis. Now, revenue surged by about 11% compared to a year ago, coming in at 12,192 crore. This was about 1.5% ahead of what the street was expecting. EBITDA, which is earning before interest, depreciation, earnings before interest, tax, depreciation and amortization, stood at about 3,179 crores, up 7.5% from the year ago period, and it was also about 1% higher than what the street was expecting. Margins, on the other hand, as I pointed out, declined by about 90 basis points or so, coming in at 26.1% and about 10 basis points softer than what the expectations were. The street was expecting a figure of about 26.2%, so 10% softer than the expectations. I was also looking at the stock, Shweta. Before I get to the stock, actually, there are some figures coming out just now. India formulation business overall on a year-on-year basis was up about 11.1% or so. The US sales, on the contrary, declined by about 8% on a quarter-on-quarter basis, but on a year-on-year basis, they were up about 4%. Now, US sales do matter because they were expected to take a be a spoil sport as far as the earnings for Sun Pharma go. They were expected to keep that revenue growth under pressure, but overall the numbers are looking good. And talking about the stock was among the top gainers today. In fact, it was a top gainer in the Nifty pack, surging about 2.5% or so. Now, today's price action marks a significant departure from the bearish trend that we have been seeing playing out in Sun Pharma over the last 15-16 days or so. On the whole, although Sun Pharma has underperformed Nifty Pharma, I was also looking at multiple time charts. Sun Pharma on a 1 month basis is down about 4%. Nifty Pharma, on the other hand, is down about 3.2 to 3.4%. On a 6 month basis, Sun Pharma is up about 15%. Nifty Pharma, on the other hand, is up about 18%. On a 1 year basis, Sun Pharma has given returns of about 7.5%, whereas Nifty Pharma has surged about 9%.
All right, that is of course the stock performance for Sun Pharma. But what are you making of the numbers, Rohit? Beating street expectations, although margins still substantially down by approximately 7.5%.
Well, not really very glued to Sun Pharma right now.
Okay.
But the only thing I just noticed while you were talking is that it's managed to go back to the 2015 highs of that it had made close to 1200. And it's almost back at that number. So yeah, that's sort of what it has done over the last 2 to 3 years.
All right, a good bounce back as far as Sun Pharma is concerned, but let's move on to top gainers and losers. Sun Pharma, of course, outshined in the Nifty index. Which were the other gainers and losers? Suyash, run us through them.
Yes, Shweta. So among gainers, apart from Sun Pharma, which was the top gainer, was BPCL. BPCL was up about 2.2%. In fact, it has extended its winning run to 3 sessions now. Hindalco was another gainer. In fact, the only gainer in the Nifty metals pack, which was trading under significant bit of pressure. It was up about 0.54%. ITC also surged about 0.5% or so. Bajaj Auto was another gainer on the back of good auto sales data coming in for the company for the month of October. Now, among losers was Adani Enterprises. The stock has been under a fair bit of pressure. We have seen a good bit of decline playing out in Adani Enterprises. In today's session, Adani Enterprises corrected by almost 3.4 to 3.5% or so. SBI Life, Coal India was another top loser. It was down about 2.3 odd percent or so. Tata Steel corrected by about 2%. SBI Life was down about 2.13%, and Adani Ports also another stock from that Adani stable, down about 2% or so. Now, sir, BPCL has been doing pretty well off late. The stock has been on a bit of a run up. I think on Monday it was up about 3%. Yesterday also we saw a good bit of a bounce back, and it was in fact among the top gainers also yesterday. Today also we have seen BPCL feature in that list. What's driving the stock, sir?
No, I can't really make stock specific comments. I'm sorry.
All right.
All right, Rohit, thank you very much, sir. Lovely having you on the show. Thank you for taking time out for speaking with us here at News 9.